Genia Turanova, thanks so much for joining us on Wall Street Unplugged.
My pleasure. Hello.
Well, so you write our MoneyFlow Trader newsletter, and you also write one of our recent launch newsletters, Unlimited Income, which we're going to get to in a minute. But I think a lot of people don't know this about you, is that you used to be an economics professor. And I know through your newsletter, you explain, which is a top-down approach, and you look at the economy. I want to start there because that's why I get the most questions from when it comes to subscribers in terms of inflation. They're out in the real world, the labor shortages and what's going on out there, and prices are being raised across the board. What are your thoughts right now where we have stocks at all-time highs, earnings are up tremendously, now expect to be up tremendously year over year, which not only year over year, but they're at record numbers, meaning that they're higher than pre-COVID. We've seen 9.3 million people unemployed, but 9.3 million jobs are out there, right? So are available. You're looking at home prices at record highs, stocks at record highs, all asset prices near record highs, yet the Fed is still pedal to the metal saying this is going to be transitory and there's nothing at all to worry about. What are your thoughts and how are you playing this in your newsletters? Because for me, it seems like inflation is guaranteed. It's here right now. We all see in every economic indicator, but according to the Fed, it's transitory and everything's going to be just perfectly fine.
Everything might be just perfectly fine, but the chances are that the inflation is here to stay. It might be a little lower than the current 5% on the Fed's preferred 4% on the Fed's preferred measure. Maybe a little bit higher. And then they're going to go and say, you know what, wait a little longer. We'll average it down a little bit. And then we had the years of deflation. So we'll have to go out a few years more. And the problem with inflation is that it throws everything out of whack. It just, some sectors start grow faster. The costs accelerate. Then the profit begin to fall. And then, some sectors begin to play catch up and materials honestly often go totally crazy. And that by itself can start a new cycle and a new crisis. Inflation is not something to mess with. And in this situation as we have today, for all this money, they just simply chase a limited amount of goods. There's nowhere for this money to go. And I think it's as simple as that. You can't put this money in the bank. Well, you can, but why? The interest is zero and minus inflation will be negative. So you let it do something in the real world, be it the market or the economy. So it is a little bit stimulatory, but this stimulus will play itself out to the way that inflation will continue to be a big factor. So I think it needs to be seen as a real phenomenon and not likely a transitionary phenomenon that will stop in 2022. There's no magic economic event that will begin in 2022, after which inflation will suddenly stop. It's just not going to happen unless we begin slowing down the money printing and possibly raise rates, which again, not likely to happen.
Yeah. It's funny because a couple of weeks ago, the Fed came out with their meeting, and a few days after that, the market really came down saying that, they're going to taper. I didn't see anything of that nature at all. I have no idea what everyone's talking about. Maybe that's why the market's bounced back to new highs. But what I heard is we're not touching interest rates for 18 months, which is a really, really, really long time. We're not going to stop buying bonds anytime soon. And you're going to be fine. It's going to be transitory, which the Fed said, we're not telling you how long transitory is. That's definition is brief, which I would think 3, 6, 3, 4, 5 months. It could extend into next year. So we talked just before this and discussed this. And I'm going to ask you the question that you asked me because it's important. When we looked at 2008, we saw a Fed even 2007, the Fed was raising interest rates and they were wrong. They didn't know what was going on. But they said, okay, and reversed it, which is fine. why wouldn't they do that today and say, okay, we're gradually going to raise rates, and if it's transitory, we could take whatever, we could take them back, whatever it is, but they're seeing things that aren't there to the point where, they're saying that we still haven't seen us come out of the woods from COVID, which we have on every single level. Asset prices, you're looking at jobs, we're looking at everything, right? The actual unemployment rate isn't as low, and that's what they're focusing on, but it really is if we stop giving free money to people. They're still printing like crazy. Again, everything is more better, profits, margins, more better than they've ever been. So I'll ask you the question, EXP, like, what is the Fed afraid of here? Because everything is pointing for them to gradually just start taking away the punch bowl. It just makes sense where we are right now, but we're not seeing that at all, and it's leading to massive speculation. Very easy to raise money these days. ESG companies with no profits going through the roofs, the AMCs and everything. You're just seeing so much risk taking and craziness out there. But what is the Fed afraid of? You asked me that, and I don't know. I said politically, it seems like it's more a organization that's politically controlled than ever. Happened in the Trump administration, even now. They're supposed to be separate, but why wouldn't the Fed use a strategy like that? And I guess we can go into the consequences if we do see a lot more inflation.
I don't know if they're exactly political or if there's anything they know that we don't know. But it looks like they're afraid of the tantrum. They don't want a stronger dollar. We want to be on the same page as the rest of the developed world, which is also in the extreme easing, in the state of extreme easing, money printing, and zero or negative interest rates. So we all march together, but where we're going, I guess we're going to find out relatively soon whether it's going to be higher inflation or it was just a big scare, nothing to worry about. We'll leave 2021 with the inflationary spike as if it never happened. I don't think so, and most of our observers really are skeptical. But you know what? I think they're all afraid of the tantrum that the market would throw. And the market is so used to free money that it will throw a big tantrum. And again, it's a vicious circle.
Now, tantrum, talk about that, because when I look at tantrums, I'm looking at what industries are going to be impacted the most. And one of the things that you wrote about in your newsletter was, higher inflation means higher PE stocks are at a disadvantage. Can you explain that? Because we're seeing, sectors within technology where PE ratios are through the roof. We're actually seeing it in restaurants now and retailers. I mean, trading at incredibly high, historically record high valuations here. And again, we have a perfect environment with free money and low interest rates, and I get it. But if we do get inflation, is this some of the industries that can get hurt, the high PE names? And one of the sectors that you actually brought up, which, I want you to go into more detail because it was amazing, is cloud computing. Because right away we think, Microsoft, we think Amazon, Google, those are the three leaders. Those guys are going to be perfectly fine. But if you're looking at the individual and tons of those little, niche companies within cloud, and they're trading at enormous PEs. I mean, even, the snowflakes, which have everything and all the analytics and stuff like that, they're trading at PEs that are pretty much insane. Now, these are the names that you should be worried about if we do see inflation tick a lot higher than what everyone's expected here.
I do. And I would. If the market is anything except for a big casino, we should all worry about high PE stocks in the high inflation, because what at least in theory and mostly in practice over the years, the market assigns value to future profits. It's all there is. You buy a corner grocery, not for what they did yesterday, but for the business they would do tomorrow and the years ahead. And you don't want to pay too much. You want to pay just right so you can live off that corner grocery. Again, I'm simplifying, but That's basically the same principle should apply to stock market. You value stock on the basis of its future profits. The profits could be far, far, far in the future, and that's fine, but you don't want to pay too much for that future growth. And the value of that paying too much is actually going down as inflation is accelerating, simply because you might be able to get that amount of money from somewhere else without paying too much today. It's just not worth the risk. This money today versus future money, inflation reduces the value of future money. High PE stocks, that applies to them as well. Cloud computing is a great example, but of course not every cloud stock is going to be impacted. Amazon, Microsoft, they're very expensive, but they're not as expensive as Zoom or Coupa software or any other smaller cloud stocks that you can think of. In 2017 or 18, you couldn't give away many of those cloud software stocks. Mm-hmm. I know that the COVID changed everything, but did it change everything to the profit don't matter anymore? Probably not. So I'm thinking that investors eventually would still want to see profits, and they want to see profits sooner rather than later, and they want to pay less for the unit of future profits if they see high inflation. That's why high PE stocks might be in big trouble again if inflation continues to stay here or accelerates.
No, it definitely makes a lot of sense. And thank you for explaining that too, because sometimes people just say, hey, high PE stocks are going to get hit. But I love the explanation, which you also do great in your newsletter. And I want to transition to that to MoneyFlow Trader. Kind of threw you into the fire a little bit, right? Because this was designed, this newsletter, and we changed a little bit of the format, which is great because you can go long as well and use option strategies. But it was meant to really hedge your portfolio, right? Because stocks have been hitting all-time highs almost every single year since the credit crisis. The timing was perfect in terms of COVID, which, we saw a lot of industries and many, many stocks get hit. But now, even though stocks were seeing all-time highs, we're seeing certain sectors get hit. I mean, ESG sectors got hit. We saw SPACs get hit. Some of the high-growth names gotten hit. I've seen names down still 40, 50% from their highs, especially companies that just IPO'd in the last, pretty much 7 to 10 months or so, last couple of quarters. Explain MoneyFlow Trader, and because you use simple option strategies to help hedge your portfolio. And I think that sometimes when people may see a portfolio, they'll see, hey, there's a few things that are down but you're only risking as much money as you put in because you do it a special way. I'll let you explain it. But how important is it to hedge your portfolio? Because I think what I'm trying to do here with Curzio Research is explain how professionals invest, and they're always hedging themselves just in case, because you're going to be wrong. And, sure, if that hedge doesn't work out, pretty much everything else should work out very, very well to cover that. And yet, if everything else goes down, that hedge could be worth more than 30, 40, 50% of your portfolio. But yet, when you see stocks continue to hit all-time highs, it's not the easiest thing. And I think this trend is going to break with inflation here. But yeah, I think MoneyFlow Trader over the next couple of years might be set up as one of the best newsletters we have in our suite of newsletters. But why don't you go explain it yourself? Because that's why I created this. You have changed this model. It's been fantastic. You've been long and doing great. So, explain the importance of hedging your portfolio and the product.
Well, as you said, absolutely correctly, you pointed out that you want to be able to be invested without worrying too much on what happens with the market tomorrow. Long-term investing is the key to long-term wealth. This said, nobody can time the market. We can understand what's going on. We can analyze it to the best of our ability and discuss about inflation and discuss inflation till we're blue in the face. But the market has its own ways. And, somebody said that, the market is best at making you feel the maximum pain. Well, you will not feel that maximum pain if you are just a little bit hedged. You should be able to, well, if you do it correctly, or even if you just do some of the balancing out of your portfolio, you should be able to stay long and be somewhat or significantly, depending on how you do it, or how much of the put options you do have, be hedged against any adverse market reaction. We were talking about inflation, but again, market can surprise you, and the life surprises you every time. I mean, the Delta variant could be the horrible thing that brings the market down, or it could be nothing, and the market will continue to rally and double from here. We don't know. So you want to stay long, you want to be positioned as best as you can, and you want to have hedges. The hedges will make you money when the rest of your portfolio does not. And almost by definition, when your portfolio is doing fine, your hedge will lose out. And again, that's what hedging is. But you do it to stay safe, and you do it to make money when others don't, and when the rest of your portfolio doesn't. That's why you buy selective puts, and again, you do it to the best of your ability. And you try to balance out your risks and try to predict, again, to the best of your ability, how the market will react to this or that event. Today, we're talking about inflation. We do think it's the biggest risk of the market, but again, it may surprise
you. And what I love what you're doing here is, and I want to explain, because when we talk about it coming from the institutional side, this is normal, right? But for retail investors, most of you are just long. We're not telling you to go blindly short, right? Or naked short, anything crazy like that, where, if it just goes the opposite direction. I mean, if you put money into a stock and it goes to zero, you lose whatever money you put in. But if you're short, it's infinite, right? You can go higher and higher, go to 1,000, 10,000, million, who knows? What you're doing is when you're buying these puts and long dated puts, you're betting against the stock or sector. But if you're wrong, you're only losing the money you put in, right? So, which is important to understand. Like you said, what if you lose that money, then chances are a lot of things in your portfolio are probably doing well. But like we saw with COVID, and that's an extreme event. But even if we see, I think I read a stat that we haven't seen a 5% pullback since October. I think I read that someplace yesterday. I couldn't believe that. But when you see a 5-10% pullback, which means, if you've seen a 10% overall pullback in the market, you're going to see a lot of stocks down 20, 25%. If that happens, I mean, the value of that put isn't just, hey, I made a little bit of money. They can go up 3x, 5x what we saw during COVID. I mean, they can go up tremendously and account for a big part of your portfolio. But that's what, for me, starting this company is not just about giving people stock prices, about educating them and educating how I've been doing this for 25 years and you've been doing this forever as well, is because, we hedge ourselves, we do the research, we do the homework, and that educational component is tough. But I think, and even you could probably explain this better, of how easy this is, where you could do this from your E-Trade account, your Ameritrade account, whatever account you have, Fidelity. It's not a hard strategy. It's very easy, and you walk everyone through it. But that's pretty much the basis of it, right? I mean, and not only that, you do have long positions and options and stuff like that you've benefited greatly from in this newsletter too, right?
Yes, we, again, seeing how this market is unstoppable, we kind of pivoted a little bit and discussed with you, and we made quite a few trades that were for the market, not against the market, and we were able to have booked some gains last year and this year as well. But of course, the main goal of MoneyFlow Trader is still hedging. It's what it was created for, and this is what it's needed for. And I strongly believe that some hedging makes you safer. Some hedging makes you stay investing. And it's really not a difficult strategy to execute, and it's not as risky as you said, shorting. And again, speaking about shorting, it was almost a theoretical exercise talking about being short a stock, and you could lose much more than you have put in. and was almost a theoretical exercise until this year, incredible runs of all the, GameStops and AMC and the rest of the Wall Street bets favorites. You really could have lost, and hedge funds did lose a fortune on those short bets. Put options are different. Even if you hold it until expiration, which every option does have expiration, even if you hold a put option until expiration and your stock never reaches its target, and the option expires worthless, which can and does occasionally happen, all you can lose is the amount invested. That makes it easier to plan and easier to understand just how much money you can lose and just how much of the potential losses you can afford, and balance out your risk-reward scenario in terms of how much money you risk and how much of the potential reward can happen in this specific scenario. And that's really all there is. You can also trade call options, which is the opposite. You bet on the stock's upside, but the basic gain-loss scenario is still very similar. You cannot lose more than you put in if you are long a call or a put option. Shorting options is a totally different story, but we're not going there. All we do is buying in the MoneyFlow trader.
Yeah, and thanks so much for doing, because everybody's subscribed to that newsletter. I mean, how you describe it, how easy it is, and going through and walking people through those steps is pretty amazing, which is awesome. So I wanted to transition next into unlimited income, one of the products that we just recently launched. And when I was looking at this product and when we talked, and I thought you were perfect for it, because when it came to unlimited income, there's thousands of products out there that are going to tell you how to generate income. And I think you know as well as I do, 95% of them are really not that good. It's a different formula. It's an art to it. It's I think people don't understand that it's more than just looking at, hey, this pays a high dividend. That's great. Even though it pays a 3% or 4% yield, if the stock goes down 10%, it's kind of useless, right? Explain the methodology in this and why it's different, because we'll go over your track record in a second, which is absolutely unbelievable. But why is your strategy, your newsletter, your income newsletter different than anybody else's unlimited income?
Well, I think what you want with income, especially in this market, you don't want just the dividend, because if you go for just the dividend, you are faced with the basically two options. You can either go for a relatively high dividend or you can go for extremely low dividend. High dividends are risky in this market, and that's a problem. Why are they risky? Because either they come from a enhanced income vehicles, such as possibly closed-end funds, or maybe even an MLP that pays out specific income. And it's risky not just because it's too leveraged. It's also risky because the security that pays you that income, it's not likely to grow. If the company doesn't grow, or in the case of a closed-end fund, a fund doesn't grow, they can't grow dividends. That's one. So your income stream is at best steady. And two, the price of that security is not likely to go up. And again, more likely than not, it will decline over time because the company isn't growing. And if the company doesn't grow, what is the value of its future profits? The value of its future profits is going down. This is why the company doesn't grow. You tend to see its price declining over time. And when we talked about unlimited income, our idea, we were basically on the same page, was to buy growing stocks. Income was almost a secondary factor in this calculation. Of course, I say almost because we're buying this for income, but your income must be growing, and it will be growing only if it comes from a growing company. And that's basically the idea and the execution behind the newsletter.
No, and it's interesting because I think people believe that Warren Buffett just, he is where he is today, just buying Wells Fargo and buying Coca-Cola and holding on and compounding the dividends. No, it's compounding dividends and the capital gains. And that's what you have to realize. And when we discussed this and even, launching this product, I was really excited about it. We were on the same page because I feel like that's not out there. There's not products like that. And just to show how much of this has been working, I took a look at your track record before we came on. You have 18 stocks outside of the last one that you just recommended, which is down 0.8%. And that you recommended a couple of weeks ago. You're going to hold it long term, but 18 open positions, 0 losses. You're obviously looking in the right places. Granted, it is a bull market, but we've seen a lot of stocks get hit as well, individual names, even sectors. But this formula seems to be working where I don't know a lot of income investors, when I speak to them and ask them about that, they say the word growth ever. Like they don't say, well, this is a good growth company and it pays a dividend. They're more like, oh, this pays a 5% yield. What do you think? It's never talking about the growth opportunities. You need that company to continue to grow. They could continue to raise those dividends. A lot of times they buy back stocks. And again, you're getting that capital appreciation, which I just don't, for some reason, I don't hear a lot of people talk about that, even though that's the way some of the greatest investors invest, right? And, the fact that you've done that with that portfolio is absolutely amazing. I know everyone has to be very, very happy, especially with the performance, the track record with it. So, I'm just very, like, the products that we launched and even especially limited income, which is really, really cool. So, I'm glad it's one of the last products we launched, as I said earlier, but great job. I wanted to give you, a compliment on that. And last thing here, you know the deal. You know the deal. What I'm going to ask you, right? So everybody wants it and they love it. So, and I try to get this out of all my guests. Is there a pick that you can give away that you like right now around these levels and you could share with the audience?
Yes, I do. And actually I have one for income lovers, but it's not going to pay you 5%. It's going to pay you 1.6%. And with the potential for that dividend going higher. And the condition for the dividend of going higher is the upcoming merger. But let me backtrack a little bit. The company is called Analog Devices, as simple as ADI. And the company actually calls itself ADI as well. So, I'll call it ADI from now on. So ADI is a semiconductor company. And, it's in that niche of the business where the margins are steady, the product turnover is relatively low, and the market is exactly where you want to be. It's power management, it's signal processing, it's automotive, it's everything you want specifically in 2021. And on top of this, it's buying a similar company. And the merger is they're likely to go through this summer. And as soon as they complete the merger, ADI promised they will reevaluate the buyback and the dividend, their programs. So we'll potentially see a higher dividend from this. So again, fingers crossed, but it's a great company in a good business. And you get a semiconductor play, which is not Intel, for a nice yield, with a nice yield.
No, that sounds great. Well, I think we covered a lot, right? We covered inflation, economics, MoneyFlow Trader, gave us a pick, and also limited income. So, listen, I say this to you almost every interview. I'm just so happy that you're part of our company. You provide incredible value to all of our subscribers that subscribe to your products, and that's always the most important thing from my point of view. And just very, very proud to have you on, and love the job that you're doing, and keep doing what you're doing, because I know you have a lot of fans, and that fan base continues to grow, which I know for a fact. So Thank you so much. I really appreciate it.
Thank you very much. Thank you. Thanks for listening.